InFi, episode 39.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. This episode is going to be a fun one. I'm going to be going solo, and in recognition of the recent anniversary on the Facebook group that we here at Infineo are involved with that's dedicated to infinite banking, I thought it'd be fun if I went and grabbed some things that were offered by members of the group in terms of online hit jobs against infinite banking or whole life more generally, and that I would just respond to it. So let me say, for those of you who participated in the ask, a couple of you gave me videos that certainly qualified, but the problem was the people were responding, like they grabbed somebody on social media touting infinite banking or whole life in general, or they may have called it something else, but it was the same basic concept. And then the cynic was going through and pointing out some of the problems. So a few of those that you guys send my way, I'm not going to go over here because it's the kind of thing, well, yeah, like that person who advertised it that way or discussed it didn't do a great job. And I understand why the cynic thought that's not good. So I'm not going to get up here and, defend someone who was poorly explaining how infinite banking works. Fortunately, none of the people that I saw doing that were people I knew. So dodged the bullet, right? So what I am going to do though now here is I'll go through 3 good examples. I'll play the clips at some length just to, so I'm not cherry picking and you can see what the critic's point is, and then I'll respond. All right, so that's what we'll do in this episode. So the first clip comes from a guy dressed up as Santa Claus. Why is he dressed up as Santa Claus? I don't know. Maybe if I rewound the tape to the beginning, we would know, but I just don't know. So it'll be a mystery to us. Try to get past that and focus on his arguments.
What's a piece of information that you learned that feels illegal to know?
The infinite banking system. Credit card debt, for example. Instead of paying the 18 to 20% interest on that credit card debt, what you do is you put your money into a whole life insurance policy and you borrow against the cash value and you pay the credit card off and you pay off all your debt. Now, you were going to pay the 18% anyways. So instead of paying the 18% to a credit card company, pay the 18% back to yourself. And now what you're doing is you're paying yourself the interest versus a bank. But meanwhile, that cash value is uninterrupted, which means it keeps growing. It's as if you never took the money out. Why? You didn't take it out. You just borrowed against that amount from yourself. This is what some of the wealthiest people on the planet do, including banks. It's one of the smartest ways for you to grow your wealth, for you to become your own bank and be dependent on only yourself.
That's definitely not true. Insurance agents have been popping off on TikTok about, insurance products, really sharing a lot of misinformation. And if you aren't familiar, infinite banking, whole life, IUL, all kind of the same family of products. And all it is, to be blunt, it is expensive life insurance. The premiums are like 10 times that of a term life policy. I don't know how you go about paying off a credit card debt by entering a life insurance policy. If you're in credit card debt, you probably don't have the money for that premium. Now, if you're unfamiliar with how whole life insurance works, the basic idea is that you pay a premium to the insurance company, again, for life insurance coverage. It's a permanent policy, meaning that unless you have a different term, you'll be paying premiums for your life up until the day you die, at which point the death benefit will be paid. But part of your premium, outside of covering the fees charged by the insurance company, will go towards what's called the cash value, which you can borrow against. You can technically withdraw it, although there's a big caveat to that. And while it's in the account, yes, you can gather dividends or otherwise have an investment product. And while it's in the account, it grows tax-free. So it's not being taxed on that growth. But there are a lot of things that make this really inappropriate for a lot of people. You see, a lot of agents will tout the benefits of that cash value aspect and the idea that you can borrow against it and that's all tax-free, whatever have you. But what they don't highlight is that, yes, you can borrow that money. Technically, you're just borrowing from the insurance company, that's still likely going to be a net cost for effectively using your own money, because you're not paying the interest rate to yourself, you're paying it to the insurance company. It'd be like buying a house so that you can get a home equity line of credit. Also, anything withdrawal without surrendering the policy will reduce your death benefit, so you don't get your cake and eat it too. You either get the cash value or the death benefit in many cases. And instead of all this, if you need to use your own money, you could just not buy a whole life policy, invest the money, and then use it. Now, there can be a tax benefit for really wealthy people, which is why, these insurance agents will highlight, oh, this is something the rich are doing and the wealthy are doing. Yeah, because they're rich and wealthy. That tax benefit means a lot more for a really wealthy person than it does for someone with credit card debt or someone who, is just starting off with investing. At the end of the day, whole life is insurance. And while there might be an application for very wealthy people, it is not a method for the average person to build their wealth. For most people, it's going to make a lot more sense to take out a term insurance policy that's going to cover your needs if you were to pass away. It's going to save you a lot more money. And then you can invest the difference into your own cash value account, your own brokerage account or whatever, that there aren't any terms about accessing. Better yet, you can utilize tax advantaged accounts to also gain a tax benefit using this money. If you ever have an agent trying to sell you one of these policies, just ask them how much money they're making in commission from it, because you'll see why it's such an expensive contract.
Okay, so Santa there made several points. I'll just go through them. And I want this episode, folks, to be kind of fun and quick, so I won't give huge, voluminous, point-by-point rebuttals to every last jot and tittle of these points that the critics bring up, but I will try to hit some of the major elements here. Okay, so as far as the last points there, well, it's still fresh in your memory. Let me hit those. So as far as the commission, so yes, it is true that among life insurance products, a whole life policy has a higher commission for the agent than certainly a term or other types of policies. And it's partly because it takes a lot more time and effort to show someone why they should get a whole life policy, right? That a term policy is, really quick. People just go online and get it. So there's not too much education of the consumer involved in a term policy. And so it makes sense that a whole life policy has a higher commission because, again, there's more explanation involved on the front end with one of those things. All right. But having said that, it's not when he earlier talked about, and these policies can be like 10 times or 15 times, I forget the numbers he used, the range of the premium of a comparable term policy. And then to also be talking about the commission, he leads you to believe that the reason they're so much more expensive than a term policy is because of all the agent commission. That's not true at all. Okay. The primary reason a whole life policy has a higher premium for a given death benefit and for the same insured person in terms of their age and health and so forth. The fundamental reason that it's a lot more expensive is that it's for their whole life. All right, and I've gone through this a lot, but let me just go ahead and do it again here in case you never heard me make this point. Just go online and to one of the term policy calculators. You can get immediate quotes and just type in some hypothetical 35-year-old non-smoking man or woman, whatever you want to do. Just pick something, a profile, and then say, okay, for whatever, $500,000 of death benefit coverage for a 5-year term policy, and it's a level annual premium, how much? And it'll give you a number. And then same person, hypothetical person, change it to a 10-year term policy. And then what's the level annual premium? And see what happens to it. And then put in a 30-year term policy, saying, same original person, but now we get that $500,000 death benefit for 30 years. And then what's the annual level premium I'm going to pay each of those 30 years to keep that policy in force, and go ahead and hit calculate. And you're going to see that the premiums start going up very aggressively as you lengthen that time horizon. So why is that? Is it because life insurance companies are implementing a scam and a 30-year term policy is a ripoff because it's so much more expensive than a 5-year term policy for the same person and the same death benefit? And wow, there must be a lot more overhead packed into and agent commissions packed into these 30-year term policies because look how much more expensive they are. Well, no, obviously not. It's because you're much more likely to die over the next 30 years than over the next 5, right? And so if you're a 21-year-old and you get out a whole life policy, in the US right now, that's effectively a 100-year term policy, right? Because it goes up to age 121. Then technically there, it's not just that it expires. You actually get the principal, if you happen to be still alive. So it's even better than a 100-year term policy. But I'm just making the point, if you can see how rapidly the premiums escalate as you go from a 5 to a 10 to a 30-year term policy for the same person and the same death benefit, well, now if you extend it out to the person is age 121, which is what the termination point is now in newly issued U.S. life insurance policies, whole life policies, what do you think is going to happen to that premium? And it's not because, there's so much agent commission. It's just because of the nature of the actuarial realities. All right. So that's, again, people throw this out without explaining. If these guys did a decomposition and they used actuarial tables and such to try to back out and show, okay, this is what percentage of the jump in the premium can be attributed to the underlying mortality, and then this amount we have to blame on commissions or, padding the expenses or whatever, that would be one thing. And I'd be happy to see that analysis. I'd be curious to see what they come up with and make sure I agree with their math or their logic. But they don't do that. They just naively point to the difference in the cost between a term policy and a whole life policy, and then lead you to believe that, that's prima facie evidence that it's a ripoff. And then they usually, in the same conversation, throw in, they make a ton of commissions on these things. That's why they're trying to sell it to you. All right. Also, too, with the commission, that's all in the illustration that you're shown, right? So it's not that you see the illustration as a potential policyholder, and then you go ahead and get it, and the first year's results are much worse than what your agent showed you when he was trying to sell it to you, because, this didn't have the commission built in. No. Like, what you see is what you get. There's guaranteed parts and there's non-guaranteed parts, but I'm saying the expected effect of the commissions and the other overhead expenses that get expensed in the early years of the policy, that's all built into the numbers that they show you when they say here's either, they had two different streams. It's one is a guaranteed side, and then the other, they're saying we will likely pay dividends and you as a policyholder are entitled to those, depending on what kind of company you're going with. And those projections and guarantees already take into account the commissions. All right. Near the end too, also, he said something like, if you're much better, just go ahead and get a term policy for your death benefit coverage, and then go invest in these other possible things where you can get your money without all these terms. And the other stuff, I kind of get what he's saying. I just think he's wrong, or he's being misleading, and maybe not even intentionally so. Maybe he just doesn't get it. So I'm not accusing this guy of being dishonest. But on that one, that doesn't even make sense, right? He hadn't established that there's all kinds of terms to be able to use your money in a whole life policy. No, his arguments were it's not earning a high rate of return, right? One of the main selling points that he alluded to was if you put your money in a whole life policy as opposed to one of these, like a 401k or what have you, you have access to your money right away. It's not that it's in prison until you're in your 60s, the way it is with these other typical tax qualified retirement plans that the financial gurus recommend as being no-brainers. Okay? So no, you could say other things like, maybe you're going to earn a higher expected rate of return with a 401k that's tilted in favor of the stock market. Okay, we can have that discussion, but to say, rather than putting your money in a whole life policy and practicing this so-called infinite banking, why don't you put your money in vehicles where you can access it on your own terms? Like, no, that doesn't work at all. Or if you are putting it somewhere where you can get access to it, then it's not going to be getting the tax advantage growth. That's what I'm saying. So that's the thing too with a lot of these guys. Dave Ramsey does this a lot too, where they're moving targets. Like, in order to knock down one particular claim on behalf of whole life or infinite banking, they will say, instead of doing that, you could do this thing over, strategy number one. And that is better on that one dimension. And then when they get to a different argument in favor of whole life or infinite banking, Dave or some other random critic will say, oh no, I can give you a different strategy that outperforms on that one particular metric. Call it strategy number 2. And they can go through that. And so like you can list 5 things that are pretty good about whole life policies in terms of a robust asset class. And then Dave Ramsey can go through each of those 5 points and find some other strategy that outperforms on that one metric. But he's just listed 5 different strategies. It's not that each of those strategies is better on all 5 dimensions, right? No, it's just that they each outperform on that one. But then if you say, okay, but given that I have to put money into one of these now 6 possibilities, the point is the whole life is pretty good on all these 5 criteria, where these other ones, they might be really good on one criterion, but awful on the other 4. Okay, so that's, you run into that a lot too. So just be careful. So I'm saying with this case with this Santa guy, that he's saying, oh, you'd be stupid to put your money into a whole life policy because you can earn much better tax advantage returns elsewhere. Well, then he can also be claiming, oh, and with these other investments, you can get your money earlier. No, you can't. That's part of the reason you might not want to take advantage of these so-called no-brainer options, is because your money is effectively in prison. Okay, now in fairness, maybe what he had in mind as I'm walking through this with you guys, maybe he meant that, oh, because you have to borrow against the policy to get access to your money. So yes, in terms of standard infinite banking practice, that is what you would do, but you don't have to. Right? You could, for example, elect to take the dividends, right? So normally the default move, if you're doing infinite banking, is when your whole life policy kicks off dividends, you reinvest them back in the policy to buy more paid up additional insurance, which you could do without further underwriting. That's all. The optionality of doing that is built right in to the contract when it's first issued. So if it makes, if you like having a policy that's size 100, don't you want to have a policy that's size 110, right? That's kind of the logic of it. So other things equal, you probably want to be plowing those dividends back into buying more paid up insurance to grow your system, as it were. Okay, but you don't have to do that. If you wanted to, you could just elect to get those dividend checks in them. Well, either the mail or physically mail in checks, or just directly deposit into your checking account or whatever. You could do that. Now, at some point, there's tax consequences. Once you withdraw dividends up to your cost basis, then if you further took out funds, the IRS is going to say, obviously with all those folks, I'm referring to the U.S. context, is going to say, even if it's not a MEC, hang on, we got to start taxing you on that, because now on net, you've made money on this policy. Once you've gotten more in dividend payments than you ever put in historically in terms of premium payments, well, then at this point, we got to treat this thing like it's an investment, because this is certainly doing more than standard life insurance, right? That's kind of the intuitive story behind it. Okay, so there are those issues, but I'm just saying, in case this guy thinks once you open up a whole life policy, the only way you ever have access to that money is either you have to die or surrender it or borrow against it. Well, no, there's other options. You could also even partially surrender, right? So there's all kinds of flexibility you have even with a plain vanilla whole life policy. Okay, as far as is right out of the gate, his initial complaint, it is true, and I also am concerned, just to make sure the public's not being misled, that yes, some of the real quick marketing blitzes you'll see, it could make it look like it's free money, and that, oh, if you got all this debt over here, hey, just take some money, put it in your policy, borrow against your policy, pay off the debt, and your money's still growing. And depending on the exposition, and if it's a real quick thing, it might lead you to believe that it's costless and that, like there's a magic money pump going on here. So obviously that can't be correct. However, having said that, it is true though that you can, someone coming in to help a client come up with a better financial plan that involves the use of a whole life policy and infinite banking as a process to use with that policy, serving as like the vehicle or the chassis, that can involve rapidly paying off credit card debt. Okay, so I'm not going to get into specifics here, but I'm just saying, yes, this guy, the Santa guy, is right that just that particular ad in and of itself, if you didn't know anything about how whole life policies work, you might have the wrong idea of how this procedure would work. But having said that, like I said, there are people, and because what happens is people can get in ruts where they would have a standard corporate job, let's say, and a big chunk of their paycheck gets taken out and put into a 401k or some similar plan. And maybe the employer is matching it because, Dave Ramsey, Susie Orman, the HR guy at the company, all assured them, oh, this is a no-brainer. You totally want to be doing this. Look at this great, look how historically the stock market is the best place to put your money if you're, middle class like you are, Mr. Smith, and go ahead and we'll do that. And then you go out and you buy a big house with a 30-year mortgage. And so that means in the beginning, you're mostly just paying interest and, hey, lifestyle. And you want to keep up with the Joneses, as they say. This guy's Smith, right? So yeah, the Smith wants to keep up with the Joneses. And so you end up running up credit card debt. All right. So what it can be a dumb situation is if you're plowing money into, some other assets that are earning even optimistically in the long run, 8%, let's say, where you've got credit card debt rolling over at 19.9% APR or something. Okay. So in situations like that, using a whole life policy where you start transitioning money. So instead of continuing to fund these other investments that you can't touch until you're in your 60s or 59 and a half, whatever it is, without penalty, instead start flowing at least a portion of money into the whole life policy. But then that's not just money that's gone forever. You can, especially if you structure it properly so that the cash starts accumulating rapidly and right off the bat, you could borrow against that to go knock out the credit card debt. Okay, so it's true. If your only job, if the only goal you had financially was, I want to pay off my credit card debt as quickly as possible, yes, going and setting up a whole life policy would not do that. You could just take the money that you would have paid the whole life and just directly pay the credit card company. But the point is, once you had that knocked out, you wouldn't have a whole life policy that was now, 3 years old. And so given that you want to get to a point where you have this robust whole life policy that's, gotten over the hump of the early years when the internal rate of return is negative and so forth, it can make sense to go ahead and start doing that right away when you tweak your flows of the money that's coming into your household and then flowing out into various outlets, and to redirect some of that to start funding a whole life policy. The point is, if you've also got certain debts rolling over at ludicrous APRs, you can borrow against that whole life policy at a much lower interest rate, right? So the carrier charges you a much lower interest rate for a policy loan with the cash surrender value serving as collateral that you can then go and knock out these other debts. Okay, so yes, everything I just went through was not distilled down into that TikTok ad that the Santa guy just looked at. I grant you, but I'm saying it actually could make sense with the right advisor who knows what he's doing to meet a client who's got a bunch of credit card debt and then show them how, hey, you can change what you're doing using a whole life policy and practicing what's called infinite banking that does involve flowing money and premium payments to bulk up this policy, and then you borrow against it to knock out your credit card debt. And so in a sense, you're transferring the debt from the credit cards over to the carrier, the life insurance carrier, right? So that's one way of thinking about what you're doing. And among other things, why would you want to do that? Well, because the interest rate that the carrier is charging you is much lower than what the credit cards are charging you. Okay, so I just want to make that point. Okay, let's now move on. Oh, the last thing though, before is notice how he said, oh yeah, this can make sense for rich people in banks. And we're going to see that in this next clip as well. So it is funny here how the people telling you that whole life is either not a good idea or some of the, not the Santa guy, but the other ones, like they actually have that it's a scam. Some of these things in the, in the YouTube title to presumably to try to grab people and make it more provocative. And it's funny that something that's so stupid, and why would you want to do this, and don't listen to these agents who are just trying to make commission. Oh yeah, rich people and banks do this, but that's because, and then they give you all these reasons why rich people are doing it, right? So can't be as open and shut as, oh, this is a stupid thing to do. Why would you put your money here? This is just a scam for these agents to make big commissions and whatever, because this is a terrible place to put your money. How can that be true if they also admit in the same discussion, oh, yeah, sure, rich people, they have use for this, but not you, mister. Okay. Let us now proceed to the next clip.
Now, I'll quickly talk through the main aspects of the infinite banking strategy that are often misrepresented and difficult to understand. The gurus will argue that the infinite banking strategy is a tool of the ultra-rich, and we are missing out big time by not using the same tool. They also argue that even banks buy whole life. Well, they're telling the truth. Banks and ultra-rich people buy whole life insurance. But why? They buy it because it makes slightly more money than treasury bills and bonds. It's a safe form of diversification for the banks and ultra-rich. They're happy getting 4% growth when treasury bills and bonds are paying less. But I can tell you the ultra-rich did not become ultra-rich because of 4% growth. They made the bulk of their money from their businesses, retirement accounts, brokerage accounts, and even real estate. Only after taking advantage of all of these and still having leftover money, they might put it in something as low yielding as a whole life policy. So it's safe, but it's not a good idea for the average person who needs to put all the income they can to work. There's a huge opportunity cost to committing to 4% growth, even if it's tax-free growth, over getting 8% through other methods like traditional index fund investing in 401ks and IRAs.
Okay, so I mean, that is just terrible analysis. So again, notice the picture here where he's admitting, oh yeah, rich people and banks do this, and it makes sense for them, but not for you. Okay? And by the way, this guy's YouTube video, the title he put on it is "Don't Buy Whole Life Insurance - Scam Exposed." Okay, so that seems a bit contradictory there, right? If he just admitted that rich people and banks are doing this, then this seems like it hardly could be a scam, right? At best, he might say, depending on your circumstances, may be inappropriate, right? That's the most he could say if he's admitting that rich people and banks do this, right? Because anything else, admittedly, you might say, well, wow, maybe he's bringing up other stuff in the video. Yeah, he probably is. I'm just focusing on this just to keep this episode of InFi, digestible for you folks, bite-sized. But my point is, whatever else he's bringing up in these other things, and it's not that he's, by the way, I watched more of it. It's not that has some crushing objection that I can't deal with, and so I'm trying to hide it from you guys and hope you don't discover it. It's just I don't think it's worth our time to go through it. But point is, whatever those other objections may be, they obviously aren't enough to get the rich people and the banks to stop buying this product, right? So how objectionable could those other criticisms be? He's admitting it makes sense for banks and rich people to do this. And he's saying, right, so the other arguments, maybe they're detrimental or not, but the point is there must be something really going for these whole life policies if the rich people and the banks are piling into them, right? And so now on this narrow question of, okay, Mr. Rich on Money, that's the title of his show here, what's going on? Why does it make sense for the rich people to do this, but not me, the little guy? And his answer, as I just played for you, is to say, oh, because the rich people, they already got rich doing all these other things. And then now, when all is said and done, they have money left over. Well, they got to put it somewhere else. Let's go put it over here in a whole life policy that earns 4%. Incidentally, notice there, at least I give this guy credit, he's being more realistic with what the rate of return is, right? If you listen to Dave Ramsey, he'll say often, I've heard him say numbers like between 1% and 2%. And so there, I mean, it must, there must be averages where they're looking at people who surrender the policy early on or something. But the point is, if you stick into one of these policies for the long haul, then just looking at the premiums you pay in and then what happens to the cash value growth, if you calculate what's the long run average annualized internal rate of return, it could eventually be higher than 4%. That growth is not taxable as long as you conduct the policy properly. to take that number and to make it comparable with some other investment that is taxable, it would obviously be a higher number to get, what's the apples to apples comparison. Okay. So at least this guy, Rich, is being more honest than Dave Ramsey is about if you're willing to commit to this strategy, what kind of returns are you going to make? Assuming you don't die, right? If you die early, then the rate of return on your premium dollars is a lot higher. Okay. We're talking about here, assume you don't die. Okay. So again, his argument is, oh yeah, these rich people, they first do all these other things and then get totally rich. And then they put the money. Hang on. We're not talking about real niche things like buying the shares of some penny stock that your expert computer analysis and regression analysis and blah, blah, blah identifies for you. And I only got room to put in 850,000 into that, but I'm worth 10 million. So now what am I going to do with the rest of it? I guess I'll go park it in this whole life. That's not what we're talking about, right? These other things he has in mind are like the stock market or real estate, right? So obviously rich people could put all of their portfolios into these other things that he thinks are much more sensible for a middle-class household than this stupid whole life policy would be, right? So the reason they're parking their money in whole life, and he kind of admitted it, he said, because it earns a higher rate of return than treasuries. I think he might have said T-bills specifically, right? So, and that's going to be true in general. Right now, as I'm recording this, we're still in this weird situation where T-bills are actually have a very high rate of return because you got a massively inverted yield curve and so on. But we're talking about, in general, whole life policies have a better internal rate of return than T-bills do. And so why would some institutional money manager or a rich person or other types of banks, why would they be piling into whole life rather than T-bills? Because there's a rate, the rate of return is better, but also they're very safe. Okay, so that's something that he just kind of glided over here, right? So it's not that once someone gets to be worth $5 million, all of a sudden they don't want more money, right? I mean, that's the way he presented that is like, would you rather earn 8% or 4%? Okay, I didn't include it here for our purposes, but earlier in this very same video, he was saying you could earn 4% in a whole life policy, but with these other things you could do, like in the stock market, long run, you're going to earn 8%. All right, so it's not that the rich people, once they hit a certain point, decide, you know what, I'd rather earn 4% of my money than 8% because 4% is enough. I got all I need. No, it's there's actually psychological studies and stuff that certain people, they even get more competitive and greedier, as it were. They're hungrier to acquire more wealth when they get above a certain amount because now they're in a new league. And now it's like, oh, geez, those guys got private jets. So that guy owns an island and you want to compete with them, right? So it's not the case that once you make your $5 millionth of net worth, then you're happy and you don't, you're not a go-getter anymore. That's not true. Okay. So if this guy is saying it totally makes sense for a middle-class household to be in the stock market, to do all these other things, earning 8%, whereas ultra rich people, oh yeah, you can see why they would go ahead and do whole life and settle for 4%. He's overlooking the risk. And that's why what he's saying, it's actually backwards. It's the other way around. If we're admitting that the whole life policy, although the expected rate of return is more modest, is far safer than putting all your money in the stock market, even if it's diversified and, it's the whole S&P 500. You're not just like picking 8 stocks or something. Well, then that's the reason that you as a financial advisor talking to a middle-class household in terms of, their overall long-run financial plan, you wouldn't want them to have everything in the stock market because it's volatile. It could, as 2008 showed, the market could go down 40% in 6 months, right? So the portion of the household's financial plan that's dedicated to, you might call it savings or cash or what have you, very liquid funds, you don't necessarily want that in something that's as volatile as the stock market. Okay. And so that's why wealthy people and banks do that, right? Because they understand that, oh yeah, you want a portion of your wealth in something that's very safe. Okay. So let me put it this way. It's typical, well, for one thing, like the rules on accredited investors. Why do they have those rules in place? I'm not saying I necessarily agree with these rules, but the rationale is, for like some hedge fund or whatever, we don't want Joe Sixpack taking his paycheck and plowing it all into this hedge fund because there's a chance he could lose it all. And so we restrict the ability to invest in these hedge funds or to accredited investors, namely to people who can afford to lose it. That's the idea. Okay, so if this guy is here admitting that, oh yeah, the appeal of whole life policies is they're very safe places to park your money where you know you're not going to lose the principal, but they also get a decent, especially considering taxes, rate of return. And so they're better than other types of very safe assets in that respect. Well, then you wouldn't conclude. And that's why only rich people should look at this. No, you would also say to lower and middle class households, you should get one of these policies. They wouldn't be as big. You wouldn't be plowing as much money into it as a rich person would. Obviously, it would scale. But it's not that, when does it become important to protect your principal only once you're super rich? No, that doesn't follow at all. The super rich can more afford to take a huge hit and lose 50% of their wealth, right? Because they're rich. It's not the middle class or the poor household who can afford to lose 50% of their savings overnight. No, it hurts them even more. So in terms of other things equal, whose savings should be in an asset that is relatively safe and less volatile, it would be the poorer people, is where you'd want to say, okay, at least they can be, they can quote bank on that money being there. Okay, now let us turn to our good friend, Dave Ramsey.
I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Money. Yeah, I have excess money in a savings account and looking to rebalance my portfolio to get it to work a little bit harder.
Wow.
But my risk tolerance is a little bit low. And he showed me how you can do this where you overfund the whole life policy. Yeah. You can access the money. You break even in year 7, and then the dividend outruns what you put into it.
Yeah,
it doesn't seem like a terrible idea in that regard, but I just wanted your take on why that might not be the best way to go.
The problem is that where it gets confusing is that, God, he's selling a dividend. A financial advisor? This is an insurance guy.
Well, he's both. They have, it's one of the bigger companies.
Like Northwestern Mutual or Prudential.
Exactly.
Yeah.
Yep.
Okay. He's an insurance guy. He's not a financial advisor.
Okay. I was about to say.
So, because those are both mutual companies. Now, there are two types of life insurance companies, mutual and stock. Okay? Likely you bought your term unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend as if they were a stockholder and received a dividend. Does that make sense?
Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so.
Okay, in other, I think, InFi episodes, I have gone through some of this stuff, so I will link. I think I went through that specific call before, but again, this Dave Ramsey clip was brought to my attention. So let me just focus narrowly on that one point there that he made. All right, so Dave is saying the only way you're going to earn, quote, dividends on these whole life policies is because you're being overcharged on the front end, right? And so that's the only way, and if they weren't overcharging you, then they couldn't give you your own money back, right? So there's a couple problems with that. First problem is, as I alluded to earlier in this episode, if you can elect to take the dividends. Like they can mail you a paper check, or they can, I think, directly deposit it into your checking account, right? If you have that all linked up. And then, like I say, at some point, if you keep doing that, it will be the case that when they go to send you another dividend check, at that point, they would have sent you more in cumulative dividends than you paid in historically in premium payments. So at that point, you would have fully recovered your cost basis. And then they start sending 1099s and reporting to the IRS saying, yes, this client of ours is on this particular policy is now earning net income. And so you need to start taxing him on those earnings because he's taking more out of this policy than he's put in historically, right? So if Dave Ramsey's right, and that was a good way of thinking about things and understanding what it means when you earn dividends on a policy, how is that possible? If the life insurance company is just giving you your own money back because they overcharged you, how can they give you more money than you ever gave them total? So that should be a big hint that something Dave's doing here is screwy. And the reason I'm, so disappointed in Dave when he goes on these frequent assaults on whole life is he's been doing this for years. And so it's not just that, maybe he just doesn't know. Either he doesn't know, or at this point, he's painted himself into such a corner that he couldn't possibly say, you know what, guys, turns out I have been totally wrong about this. And actually, he can't, psychologically, I'm sure like his mind is protecting himself from that scenario. So that's never going to happen. Okay. But I'm just saying, like, he says things that are just demonstrably false, or if you just think about it for 2 seconds, can't be right. Like I'm saying here, right? That, as to say, it's well known, or it should be well known if you know how these policies work, that if you get more in dividend withdrawals than you ever paid in historically, you start getting taxed on that. And so that's one of the things you got to watch out for if you were electing to receive the dividends, right? So how can that be if all you're doing is getting your money? So the answer, to end your suspense, is because the life insurance company, they're taking your premium payments and they're going and investing in assets that generate a yield. That for the people that die, the death benefit is a lot bigger than what they paid in, right? So anyway, the point is, put it this way. One of the problems with Dave's analysis there is by him saying the only customer is you, he led you to believe, I don't remember if he exactly said these words, that the only source of money to the life insurance carrier are premium payments. And that's not correct. No, because they take the premium payments and they go and buy assets with it. So the carrier also has money coming in the door as those assets throw off a yield. And then that's how they have the ability to send out dividends. Okay. So again, it's, I didn't just prove that whole life is a great idea, but I'm just showing a lot of these online critics who are just thinking they're blowing it up. It's, if you just think through what they're saying, it doesn't make any sense at all. Okay. That's a good place for us to stop. Thanks for your attention, folks. If you have other examples of YouTube attacks on whole life or infinite banking that you want me to look at, go ahead and send them in. If I can accumulate a decent number that are making different points than the ones I just went over, we'll go ahead and do another installment of this. In the meantime, again, thanks for tuning in, folks. We'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.